Welcome to the Chinchilla Picking Podcast, where we are here to educate you, entertain you, and hopefully help everybody make money. Dave was going to be here today. We were going to do a regular episode, but he got called to Chicago at the last minute. He should be back, I think, late tomorrow. So sometime later in the week, you'll get a regular episode out of us. But for now, we're going to go over some earnings reports that have hit the news wires in the past couple days that I believe are important. First, I'm going to check into Facebook. We'll go over their earnings report for quarter three. And then I want to look into a little bit of General Electric's earnings. I think tomorrow I might do an episode on Alphabet and Microsoft as well, because they just reported earnings today after the bell. But for right now, let's check into Facebook. Let's give this a little bit of a backdrop. Last week, Snapchat shares tumbled as the company missed its revenue target by about $3 million in the third quarter, largely because of Apple's privacy settings. This sent shares of Facebook tumbling as well. And we've heard a lot about social media companies and even gaming companies, mobile gaming companies, mobile apps and stuff like that, complaining and whining a lot about Apple's iOS 14 changes, the privacy changes. However, if you're watching CNBC or Bloomberg or any of the big networks, they often don't actually explain what these changes were. If you own an iPhone, you might already be privy to this. It's simple. The changes in iOS have allowed you to opt in to apps that track you and your purchases. So instead of allowing these apps to do it without your consent, you have to opt into it. So a pop-up message appears on your iPhone and asks you whether or not you want the app to track you for more personalized ads. If you do not opt in, they cannot track you. This has made it more difficult for Facebook and Snapchat and others to track users' dislikes and likes and purchases and ad conversions. And the most important part is the ad conversions here. We'll talk a little bit about that here as we dive into Facebook's quarter three earnings. But for right now, let's look at the basics. Earnings per share came in at $3.22 versus a $3.19 expectation. So a little bit of a beat there. Revenue came in at $29.01 billion versus an expectation of $29.57 billion that was expected by analysts. So a miss there, and that would be attributed mostly to Apple's iOS privacy changes. Daily active users was relatively flat with expectations at 1.93 billion. Monthly active users was 2.91 billion versus the 2.93 billion expected by analysts, so a slight miss there. Average revenue per user was also a slight miss at $10 rather than $10.15 per user, which was expected by analysts. So not too much to talk about there. So earnings report so far. We'll dig a little bit deeper into it. You see the general administrative cost increased 65%. Driven primarily by legal and employee costs. This meant that, in general, expenditures were up over 30%. So I would imagine that was largely driven by the whistleblower situation, increased lobbying in Washington, and so on. Facebook did say that it expects fourth quarter revenue of $31.5 billion to $34 billion. Analysts were expecting sales of $34.8 billion. So slight miss on guidance as well, although Facebook is often conservative in its guidance, so they could still, I think, pretty easily beat that analyst expectation number of $34.8 billion for the fourth quarter. Now, Zuckerberg did talk on this earnings call where he said, he mentioned that he does think that corporations, large corporations, should be scrutinized. But he believes that what we're seeing is a coordinated effort, and this is a direct quote, a coordinated effort to selectively use leaked documents to paint a false picture of our company. And, I kind of see where he's coming from. And in fact, there may actually be a short attack right now on Facebook. I don't want to be a conspiracy theorist or anything like that, but it does seem like even the good news right now was met with an editorial of negativity. I've heard a lot of people talk about, well, they're using this whole metaverse thing. This metaverse is is a distraction from what's happening with the whistleblowers and regulations and so on. I don't see that. In fact, Zuckerberg talked pretty extensively about the headwinds that the company is facing. So it didn't really seem to be much of a distraction. He kind of talked about both. He talked about the headwinds. He talked about the whistleblowing, the leaked documents, the regulatory issues, and all of that. He talked about those things, but then he also talked about the metaverse. So I don't think that this is really an effort to distract investors. And for some reason, it's bizarre. I keep seeing that as an editorial. I mean, a company can move forward with their investments, right? Despite controversy. That is possible, isn't it? I mean, it happens like every day. Are they just supposed to cease everything else and only focus on the negative things? I don't think so. It seems weird to me that with every piece of good news, there's always this little hint of negativity and editorial by whatever commentator is commentating on it. Back into the earnings here. They're adding $50 billion to the stock buyback program, which helped lift the shares about 2% yesterday in extended trading. Today it was down about 5%, so today market sentiment was a little bit more bearish. Starting next quarter, Facebook Reality Lab will be disclosed financially separately from Facebook's family of apps, which would include Facebook, Instagram, WhatsApp, Messenger, etc. So you'll start to see a little bit of a different reporting structure, with Facebook Reality Lab being more of the metaverse investments and the family of apps being the revenue and growth coming from their core business. Investments in the new metaverse technology will reduce operating profits by $10 billion in 2021. That's the largest piece of news, I think, that came out of this earnings report, because that is going to limit shareholders' equity. Now, I think that there's sort of a contradiction here to being bearish on this, because they did, as I just mentioned, increase their buyback program, but if you're reducing operating profits by $10 billion because of a new investment, you're spending shareholders' equity on that investment. You're spending money that could be used for buybacks and dividends and such. And that's why this metaverse technology investment could very well keep a lid on the price of the stock for a while, because Zuckerberg does say that he expects this investment to grow even further for each of the next 3 years. So, like I said, for the short term, this means less equity for investors, which will likely translate into lower growth for the stock price over the next 3 years, possibly at least, unless people get excited about this new metaverse technology. If they start piling into it, if they think it's great, if we get convinced that metaverse is the future, then people might get excited about it and pile into it. But for right now, it looks like it's going to keep a lid on the stock. And investors that are bullish on this hope that it pays off. But uncertainty is high. We don't really even know what the metaverse is in its entirety yet. We don't know what the preferred hardware to be in this metaverse will be. We don't know what the cost of the metaverse is going to be. There's a lot of stuff we don't know here, but I'm willing to take the bull bet. I think if you do, you don't want to jump into Facebook and expect any, I think, short-term large profits right now. Because of that $10 billion in operating profits being hit, because Zuckerberg expecting that to grow even further for the next 3 years, this is, I think, lukewarm news at best, maybe even bad news to a lot of investors, depending on how you look at it. I think that there's a good chance that that's going to keep a lid on the stock price. Now, I personally, I'm willing to take the bull bet here, because if you study business history, throughout history, geniuses like Mark Zuckerberg, when they introduce a new idea or a new concept, they're often laughed at. They're often, maybe made fun of. It's called crazy, but oftentimes it comes to fruition, especially with large investments from Facebook and Epic Games and so on. There's so many other companies that are investing in the new metaverse that I do think that it's going to become a reality. Will it be the new internet? I don't know. I can't tell you that, but I want to be what I think is on the right side of this investment. I don't want to be a bear here. I want to be a bull, because Zuckerberg's a genius. He's a visionary, and he's proven that with Facebook. I think you put some money into Facebook and you just sit on it. And I think right now, the last time I saw it was trading around $315. I think it's a fine price to get into it. It may go down a little bit lower. I do think that the metaverse is going to be a driver of volatility, especially with the large investments that Facebook's putting into it. But I am a bull on Facebook at this price. I think the forward price to earnings right now is 18 for a large growth tech company. That's pretty low. So I'm calling Facebook a buy right now, but you may not get anything meaningful out of it for a while. But sometimes the market pays the people with the most patience. So let's see what happens here. Now, the three biggest headwinds listed in regards to revenue for Facebook were Apple's iOS changes, which I talked about earlier, supply chain disruptions, and COVID resurgences in Southeast Asia. In regards to the iOS changes, which are the biggest, that's the biggest issue for Facebook, other than the self-inflicted $10 billion operating profit hit. The two major problems that come for Facebook in regards to iOS changes, Sheryl Sandberg said, are targeting and measurement. Sandberg estimates that they are underreporting iOS conversions because they can't accurately track them. So they're going to have to figure out a way to track better their ad conversions to get better numbers so that they can grow their advertising business more. Now, targeting is a bigger challenge, and it's more long-term, and they actually said this is huge here, okay? This is another reason why the stock is trading down today. She said targeting is a long-term challenge, and they will have to rebuild their targeting and optimization systems to work with less data. So those are the two biggest problems I see for Facebook stock right now. The self-inflicted $10 billion hit to operating profits next year, and the continued investment over the next 3 years that we actually hope will pay off and make us more money in the long term. But for right now, it looks like it's going to keep a lid on the stock. And then the second thing is the fact that they're going to have to rebuild their targeting and optimization systems to work with less data so that they don't violate Apple's terms and their new privacy rules. All right, let's dive a little bit into GE's quarter 3 earnings for 2021. EPS rose 19% year over year to 57 cents. This beat expectations, which were 43 cents a share. Quarter 3 revenue fell 5% to $18.429 billion. Expectations were for revenue of $19.294 billion, according to FactSet. General Electric industrial free cash flow was up $1.8 billion year over year, which I think that's a pretty big deal for a company that had zero free cash flow not long ago and was struggling to turn around. I think that this is still a good turnaround story personally. Aviation had a significant improvement in orders and things like that. They attributed that to good improvement in near-term market fundamentals. They expect air traffic increases to continue, which I think is that's a no-brainer, with COVID hopefully on the decline, vaccinations on the rise and such. They expect headwinds from supply chain disruptions to continue at least into the first half of next year, especially in healthcare. There was a revenue increase of 10% in aviation, but a decrease of 5% in healthcare for revenue and a decrease of revenue of 7% in renewable energy. In healthcare, orders were up 21%, but revenue was hit because General Electric has been unable to fill all of the orders with supply constraints. They estimate that revenue would have been 4% in the growth area and in the positive without supply constraint headwinds. In power, revenue was flat despite orders being up 8%. General Electric now expects 2021 industrial free cash flow of $3.75 billion to $4.75 billion. I tell you what, this Lawrence Culp is turning this company around. I still really, really like GE. That free cash flow number, if you would have asked the analyst 2-3 years ago, they would have said it would have been impossible to do this by now. So I'm a fan of GE right now. The outlook was consistent for this free cash flow of $3.75 billion to $4.75 billion. That forecast was consistent with expectations, which the expectations were around $3.5 billion to $5 billion. So expectations on the top end were a little bit higher, but on the low end were a little bit lower. So the forecast of free cash flow was almost right in line. For the full year, General Electric now sees adjusted earnings per share of $1.80 to $2.10, thanks to widening margins up from $1.20 to $2 earlier. I looked at this earnings report with kind of a meh. There was nothing that jumped out at me. I like the free cash flow. It seems like they're increasing their margins, which is great, but flat revenue almost completely. I think it was maybe a sequential, like a small increase in revenue over year. This earnings report here is not a reason to rush out and buy it, but it is something that you look at. If you currently own this stock, you're not selling here at all. The turnaround's still intact, which is good news. But that's what I got for today. So still bullish on Facebook, still bullish here on General Electric. Though there were some things I liked and things I also did not like in both of these reports. And neither of them really screamed to me to rush out to buy them. But they do belong in a long-term portfolio, I believe. So that's what I have for today. I may be doing a break with Brandon tomorrow on earnings as well. We'll see. Oh, and I'd be remiss if I didn't mention the fact that we're up about 20% in our little competition with the Money Vikings. And been radio silence from them, so I still don't know where they're at and how well they're doing, but I imagine we're winning. Just wanted to put that out there. On behalf of the Chinchilla Picking Podcast staff, which is me and Dave, I want to say have a great night, and I hope you all make money, unless you're the Money Vikings.